Hey everyone, welcome back to the channel. So you're looking into municipal investments, specifically municipal bonds and municipal notes, but you're probably thinking, are they the same thing? Why should I care? Well, you've come to the right place. Today, we're diving into municipal bonds versus municipal notes, and trust me, by the end of this video, you'll know exactly which one should be on your radar and why. But before we jump into all that bond and note goodness, do me a solid and smash that like button, subscribe if you haven't already, and don't forget to share this video with anyone who's as confused about bonds as you were last week. Let's go! All right, first things first, let's talk about municipal bonds, or as I like to call them, munis. Because who wants to say municipal every time, right? Now, a municipal bond is essentially a loan you're giving to a city, county or state government. These entities issue bonds to raise funds for public projects like schools, roads, hospitals and bridges. So when you invest in a municipal bond, you're essentially putting your money toward building or improving your community. Pretty noble, right? You could say you're like the silent investor in the next big city project. Without the need to wear a hard hat or get involved with construction. No dust or hammering, just the sweet sound of interest payments. Now, one of the main reasons people love municipal bonds is that they come with tax benefits. The interest you earn from most municipal bonds is exempt from federal taxes, and in some cases, state and local taxes as well, making them a pretty attractive option if you're in a high tax bracket. So essentially, you get to enjoy your investment without Uncle Sam knocking at your door for a chunk of it. But like any investment, there's a catch. Municipal bonds usually don't offer huge returns compared to, say, stocks or even corporate bonds, but they make up for it in stability and safety. You're not going to see huge swings in the value of your investment, and most of the time, you'll get your principal back, plus interest, when the bond matures. Now, there is some risk involved. If a city or state runs into financial trouble, think budget crises or mismanagement, there's always the chance that they could default on the bond. But overall, municipal bonds are generally seen as a low-risk investment, especially if you're buying bonds issued by financially stable cities or states. All right, moving on to municipal notes. So, what are they and how do they differ from bonds? Well, unlike municipal bonds, which tend to be long-term debt, municipal notes are short-term debt instruments. Essentially, these are IOUs from a state or local government, and they're issued to cover short-term funding needs. So think of municipal notes like your government's credit card, a quick way to cover expenses while they wait for taxes or other revenue sources to come in. It's not long-term debt like bonds, but more like a short-term loan they'll pay back in a year or less. Municipal notes are issued to fund projects that need quick financing. Maybe a city is trying to build a new library and they don't have the cash right now, but they know they'll get that tax revenue in a few months. Instead of waiting, they issue municipal notes to bridge the gap. And unlike bonds, these notes generally have maturities of less than 1 year. So if bonds are like long-term roommates, municipal notes are more like short-term guests who crash on your couch until they get their stuff together. And just like guests, they're expected to leave quickly. And they're usually a lot easier to deal with than your crazy cousin who overstays his welcome. But I digress. Municipal notes don't offer the same tax benefits that municipal bonds do, but they still come with the security of being backed by the government, so they're a relatively safe place to park your cash for a short period of time. That said, because they are shorter term, the interest rates on municipal notes are typically lower than on longer-term bonds. All right, let's get into the meat and potatoes of this comparison. What are the key differences between municipal bonds and municipal notes? Here we go. Term length. Municipal bonds. These are long-term investments with maturities ranging from 10 to 30 years, sometimes even longer. Municipal notes. These are short-term investments, typically maturing in less than a year. Think of bonds as the long-distance relationship and notes as the quick fling. You get the quick returns on notes, but with bonds, you're in it for the long haul. Purpose: municipal bonds. These are issued for big projects. Think roads, schools, infrastructure. They help finance the long-term needs of the community. Municipal notes. These are issued to cover short-term expenses or bridging gaps in a government's budget until tax revenue or other funds arrive. Municipal bonds are like building the future of the city, and municipal notes are like taking care of today's bills. Both are important, just in different ways. Tax benefits. Municipal bonds. Tax-exempt interest, usually exempt from federal, state and local taxes depending on where you live. Municipal notes, no tax exemption. Interest is taxable, but still exempt from state and local taxes in some cases. Look, if you want that sweet, sweet tax break, municipal bonds are your go-to. If you're not as worried about taxes and just need quick cash flow, municipal notes might be your jam. Risk and return. Municipal bonds generally considered low risk, but with a lower return compared to stocks or corporate bonds. Municipal notes, also considered low risk, but offer lower returns due to their short-term nature. Municipal notes are like a quick snack before dinner, while bonds are like a full-course meal. Both are good, but one is a little more satisfying in the long run. Liquidity municipal bonds, less liquid. They're long-term, so selling them before maturity can sometimes be tricky. Municipal notes, more liquid. Because they're short-term, it's easier to buy and sell them on the secondary market. So if you're someone who likes to dip in and out of investments, municipal notes might be more your speed. But if you're in it for the long-term ride, bonds are your ticket. All right, so now that we've gone through the nitty-gritty, let's talk about which one might be best for you. If you're looking for a long-term investment to help fund big public projects and want the bonus of tax-free interest, municipal bonds could be a solid option. They're generally safer than stocks, but they're not going to make you rich overnight. They're like the steady eddy of the bond world. But if you're more of a short-term investor or need to park cash for a few months and want a low-risk liquid investment, municipal notes could be the way to go. They won't offer the same tax perks, but they're perfect for investors who want quick returns without too much risk. Municipal bonds are like the grizzled veteran of your portfolio, while municipal notes are more like the quick recruit, a little faster, a little less committed, but still solid. All right, guys, there you have it. Now, I want to hear from you. Are you going for the long-term stability of municipal bonds or the short-term liquidity of municipal notes? Drop your thoughts in the comments below. And hey, if you learned something new today, don't forget to smash that like button, share this video with your friends, and subscribe for more investment wisdom coming your way. The more we grow this community, the more we can all learn together. Stay smart, stay savvy, and I'll catch you in the next video. Take care.